Chapter 3, that's course Principles of Accounting first part. Now we're going to start doing some adjustments. What we're going to adjust, the things that we already done. Now let's see, let's remind each other what we done so far. Obviously, we decide to open business. And since the purpose of the business is to generate income, and that income comes from the revenue minus expenses, we have to start doing some activities. Now, the way I see it, in order to run the business, you have three available options. One is to provide the service. Two is to buy and sell products. And three is you to produce the product, finish it, and then sell it. So those are three forms of type of businesses that you can um, run. If we can go that direction, you can run in order to generate income. Now, in the first part, what we saw is there anything transactions which are related to the business. So every time when there's a transaction related to the business, we're going to put it in the accounting system. How? In forms of journal entry. And we're going to put that journal entry into the journal. We're going to do debit and credit, having in mind that debit always have to be equal to credit. We may have debit more than one account. We can debit credit more than two accounts, but we keep it simple when we know the total debit has to be equal to the total credit. Also, we have accounts, which are going to help us to organize our accounting system, and accounts are related to the assets on one side of the equation and liability and equity on the other side of the equation. Then we're going to prepare those when we do the transaction, we're going to post the transaction into the journal. In the journal, we're going to combine the journal all together and we're going to call it a ledger. From the ledger, we're going to extract the ending balances of each account. Structure: first asset, second liability, third equity, fourth revenue, 5, 6, 7, 8 expenses. And we're going to prepare trial balance. This trial balance will be before the adjusting entries. Last time we saw that we can even prepare the financial statements. But now we're going to see, before we do that, we're going to make some adjustments. Now the question is, why do we need to make those adjustments? And how are we going to make those adjustments? Let's go first. Before we decide the adjustments, what kind of adjustments we have to do, we have to go back and talk about a little bit about the revenue expenses. And in terms of when revenue is revenue, when expense is expense, when the sale happen, when we recognize in the revenue, and when the expense happen, and when we're gonna record the expense. In accounting, we're dealing with time. And because of dealing with time, we have a different transactions at different time. Usually, we have two type of transactions or two type of events in accounting. Let's put it this way. In accounting, we have two type of events. First one is related to the transaction. And even when the transaction happen, we're going to think about it, is the revenue expenses actually happen? And if that happen, then we're going to recognize revenue, and then we're going to recognize the expenses. The second event that's going to happen is realization. What is realization? A realization is when the cash is exchanged. So again, we have a recognition of the revenue and expense, and realization when the cash is actually transferred from one hand to another hand. It's going to be bank transfer, it's going to be simply exchange of cash, it is going to be e-transfer. That's not so important. The important is that the money are exchanged from one account to another or one hand to another from one email to another. Now, how are we going to report those events? We're going to choose different periods. The most common period is annual. Shorter than annual will be semi-annual. Shorter than semi-annual will be quarterly, and shorter than quarterly will be monthly. So we're going to have different periods of time. And now we have to see how in those periods, when exactly revenue happen, when exactly expenses happen, because that's going to change our financial statements, since financial statements are prepared for the period of time or at point of time. Now let's see accounting period. Now the shortest accounting period that we can have in accounting will be a month. Yes, you may say, okay, how about week? Week is not big enough. So obviously the company is going to report annually every time when they have to prepare the financial statements at the end of the year. Now, is it going to be calendar year? Is it, it's not necessarily to be a calendar year. Why? Because in the corporation or the company we have, or the businesses, we have a fiscal year. Fiscal year is again 12 months, but it's not necessarily has to fall on December 31st. It can be any date. The owner of the business, when they create the business, they have an option to choose when they want that fiscal year end to be. They can choose not to be calendar year. Then we're going to have those within the period reports. Interim statements is within the period, which can give you a little bit information during the period, how the company performed, and if we have to make some decisions, when to make a decisions, and how to make the decisions. So for that reason, we're going to prepare monthly, we can prepare quarterly, and we can prepare semi-annually reports. On those reports, what we have to show? We have to show revenue, and we have to show the expenses. We always have to match the revenue with the expenses. Now, the problem with the revenue is when the revenue is earned, when the cash is received, or when the goods are delivered, or the service is delivered, or the agreement on the contract has been met. That's what we're going to think about today. And that's what we're going to talk about. So the recognition criteria is the one who tell the account when to record the revenue and what amount to be recorded. Now the revenue that we have to record has to be equal to the cash value of either services or either the goods that the company received or will receive in the future. So let's think about it a little bit. Have you ever ordered pizza online? Did anyone of you ever order pizza online? Okay, so question. When you order pizza, when you pay for the pizza online, I mean, there are different options, but which option? If I decide to go with the option to pay the pizza at the time of the order, online order, do I pay for the pizza? Obviously, I paid, right? Because this is the option that I choose. Did I get the money? Obviously, they're going to get the money. As soon as you pay for, I'm paying for the pizza, the money going out from my credit card, going directly to their bank account. End of the story. I'm closing the deal right there. The question now is, did I receive the pizza? Imagine I'm sitting right now in front of the computer. Can I order the pizza right now? Obviously, I can't, right? And even I was looking Domino, they have now $5 pizza back. So I'm purchasing the pizza and I'm paying right away. The money going out of my account and going to their bank account. The question now is, did they deliver the goods? Not yet. So can they recognize the revenue then? Are you guys with me? Again, I'm paying for the pizza, they get my money. I haven't get the pizza yet. It says the pizza will be ready in 2 hours. You have to come and pick it up. Did they deliver the pizza to me at the time of the payment? No. Do they? Can they recognize the revenue then? They receive the cash. Can they recognize the revenue? Did they provide the pizza to me? Again, let's go back to I'm paying it, not yet. So yeah, that will be the right answer. Can they recognize the revenue? Not yet. What has to happen for them to recognize the revenue?
They have to deliver the pizza.
They have to deliver the pizza, or I have to go and get the pizza. Make sense? So imagine this. I'm at home now. I'm ordering, delivering pizza. I'm paying in advance. I already pay for the pizza. We already established that's not revenue for them. The pizza man coming. Unfortunately, there are stairs in front of my place. So he texts me that he's gonna be at the door in 5 minutes. So I'm sitting in front of the door. He started climbing the stairs, and on the third stair, he tripped down and the pizza all over the floor. Did I receive the goods?
No,
Can they recognize the revenue?
theoretically, no.
Theoretically, no. Practically, also can. What they have to do in order to recognize the revenue? Bring a new pizza. And once I receive the goods, once the goods are delivered or service is complete, then they can recognize the revenue. Make sense? Let's use another example. When did you pay for this course? Are you paying after the semester or before the semester?
Before.
Before. Did you pay in full?
Yes.
Okay, what's for Douglas College? Since they get your money, what's that for them? Is that a revenue or not?
Not until the course is done.
Not until this course is done. So what is then for them?
Unearned revenue?
Unearned revenue, which is what? Which part of the
A
accounting
liability.
liability? Why? Because they owe you what they owe you, services. Or you can get your money back. Why? Because on the first week, you can get full refund. If you withdraw from the course in the first week, you're getting the full refund, correct? Does that make sense?
Yes.
Okay, so now let's pretend that you're paying for this course $1,000. For how long is the semester in Douglas College? How many months is the semester long in Douglas College? Come on, 4 months. Okay, so yesterday was the last day of May, correct? The question is, at the end of May, did you receive any services? for the money that you paid. For what period you received the service? For 1 month, correct? So let's pretend you pay $1,000 for 4 months. How much is that per month? 250. So at the end of the May, for how much services you deliver or Douglas College deliver to you? What's the value for the services that they deliver for you? For 250. So what they can do now, they can recognize the revenue on the $250 out of 1,000 that they get from you. Make sense? They cannot recognize 500 because 500 doesn't match the period. They have to wait till the end of June. End of June, they can recognize another 250. So the 250 from May and 250 from June is going to give you $500. Make sense? And they keep going until they recognize the entire. So the question is, what's the date? Situation one. Thank you for your order and check. I will get your advertisement ready. So what's happened here? The lady received the cash, or the person received the cash. He get the order for the advertisement, but guess what? The advertisement hasn't been delivered yet. Can they recognize the revenue? No. Why? Because they haven't delivered anything. Because that service is, let's say, for 1 month. Now, at the end of January, once the service is delivered, can they recognize the revenue now? Once the advertisement is run, once the month is complete, yes, now you can recognize the revenue. How about the expenses? So the revenue is recognized only and only when the service is received or the goods are delivered or the contract is fulfilled, not when the cash is received. How about the expenses? What are we going to do with the expenses? The tricky part with the expenses is expenses, we have to match it with the revenue. Why is that? Let's think about it. Let's open merchandising business. Let's start selling, what do you want to sell? Let's selling shirts. Can I sell shirt if I don't have the shirt? No. So what do we have to do first? In order to sell the shirt, what do we have to do first? I have to buy the shirt. So which comes first, the revenue or expenses? The expense. Is it clear that most of the time the expense comes first? Even if you provide the service, how many of you actually work? Okay, quite a few.
I do.
Okay. What what kind of product you providing? Are you selling merchandises, finished goods, or providing services? Service. And for that service, you get paid, correct? In form of salary. Now, do you have expenses? How are you able to provide the service? You just wake up one morning and you just figure out, you know what? Now I can work. Let's say I can work now as an accountant. I never study accounting. I never take any courses, but I just wake up one morning and says, you know what? I think I'm good at accounting. Let's go and try accounting. Do you think they're going to hire me? No. So what do I need to do first? Spend some money, take some courses, incur some expenses, and then I can see the revenue. Make sense? Now in business, we have to do this thing. We have to match the expenses with the revenue. When? On the same period. So in the same period, we have to identify all the expenses which happen during the accounting period. We have to measure the expenses, and then we have to match the expenses against the revenue which we earning. That's all. Matching expense happen only in the appropriate time period. So if the revenue is for May, expenses have to match the expenses which are related to May. When the expenses are paid, is irrelevant. For example, if I'm running a coffee shop, no, forget about the coffee shop. Let's say you're running your services from home. You're doing some bookkeeping service at home. You're working mobile from your place. Are you using electricity? Probably. When the electricity bill is gonna come? Every 2 months, correct? Yeah, but coming every 2 months. It doesn't come when the month is over. It comes after. So let's pretend that last month in May you did some bookkeeping and you earned $600. But you don't have the bill for the electricity. Do we have to show the expense for the electricity for May? What do you think? Obviously, Canada Revenue wants to pay taxes on the $500. But did you use your laptop? Did you use electricity? Yes, we did. So do we have expense for the electricity? Yes. Now, what do we have to do? We have to match that expense with the revenue in the appropriate month. Make sense? How are we going to do that? We're going to learn today. That's the objective for today class. So the other thing that we have to distinguish is accrual basis accounting versus cash basis. Accrual means that we're gonna have two events. Recording the event, recognition of the event, and realization. Recognition is when the revenue or expense is recognized, or when the asset is recognized, or when the liability is recognized. Realization is related to the cash, when the cash is exchanged hands. So the accrual basis accounting, we're gonna do those accounting records on the fact when the transaction actually happened. Was it paid for it or the cash exchange? That's not our objective. We're focusing on the nature of the transaction. As long as we have business transactions, which affect the business, affect the revenue, expenses, asset, liability, we're gonna record it. Was it paid or not paid, payable, not payable? That's not our concern. Let me see who tried to log in. Make sense? Can you guys hear me? How is the
Yes, we can hear you.
okay? How is the sound? Any complaints on the sound?
Oh, sounds good.
Okay. So that's one option. We to always to recognize the event or business transaction when actually happen, not when the cash is exchanged. The other option is to go with the cash accounting. You give me the cash, I'm giving you the hot dog, then I'm doing the records, and I'm recognizing the revenue only when the cash is received, and I'm recording the expenses only when the payment is paid. Which one will be more accurate accounting? What do you think? The cash basis accounting or accrual basis accounting?
Accrual.
Accrual. I'm going to give you an example. Imagine there's this couple. Yesterday, do you know what that yesterday was a full moon, right? So the guy want to be romantic, and but he wants to propose, but he forgot the ring at home, or he wanted to give the ring at home, not outside, because it's a very expensive ring, uh, 5 carats uh, diamond on the top, quality ABCE quality, pure, perfect. But he's afraid. He doesn't want. But he wants to be romantic and go outside. So now he going outside, choosing the moment with the full moon, and he make a proposal. The girl accept the proposal. Now, are they engaged now or not?
She hasn't answered.
She say yes. He asked her and she says yes. On the full moon, there's no way. They went to the Burnaby Mountain where the moon is full. They're like a super romantic. He make it this, but there's no ring. So can she call her parents and say, you know what? He proposed and I accepted, so we are engaged now. Why not?
I mean, they have an agreement.
Yeah, they had an agreement. There's no ring. There's no ring. So now you're on the cash basis. When you give me the ring, then we have agreement here. Then we can say there's an engagement. You're not on accrual basis because accrual basis will be the ring sitting at home. If you accept the proposal, now we engage. The ring doesn't matter because you know that you're going to get the ring. It's sitting at home. So do you see the difference between accrual basis and the cash basis? I know it's kind of tricky example, but at least you can kind of sense it now. Okay, let's go with the next one. Let's start preparing the adjusting entry. Why we have to do those adjusting entry? Adjusting entry is required for the accrual basis accounting at the end of the period. So now, what's happened on the Burnaby Mountain? The guy proposed, the girl accepted. We have engagement. Now the guy owes the girl a diamond ring, and she is about to get diamond ring. Now we went home. Now we have to record the exchange of the diamond ring that she received and he gave it to her. That's what we're gonna do with the adjusting entries. So with the adjusting entries, we're gonna deal with the timing and the difference between the transaction timing of the transaction and the actual cash exchange. Adjusting entry is gonna measure properly the period and the proper period the income on the income statement means that if there's a revenue, we're gonna recognize the revenue for the period which they earned, expenses to match the revenue for the period which they happen. And then we have to update asset and liability accounts. We have a different type of adjusting entry, but in reality, there are three main categories. They're pretty much the same, and actually there's one and there's the opposite. So it's all related to cash. In the first type of transaction, the cash has been received. Let's go with the prepaid. Let's go with the prepaid when we paying the cash upfront. If I pay the cash upfront, let's say, let's go with the example that you paying the cash to Douglas College. Did you receive the service? When you pay the cash at the end of April, have you received any service? No. Now, is that expense to you then? How is it expense? If you haven't received the service, how it's expense? When is gonna become expense? Are you guys with me?
When we're done the class.
When we done the class or when you receive the service. So at the end of the April, when you pay for the course, have you received the service?
Not yet.
Not yet. Then how it's expense for you? What is it for you, actually?
Prepaid services.
Prepaid services. And on the accounting equation, asset equal to liability and equity, which part of the
Asset.
asset? What kind of asset? Prepaid expense. When is going to become expense? When the
After we
service is
receive the services.
exactly. So we already established at the end of the February, sorry, at the end of May. Now, yesterday, in 1 month is complete. Have you received service for that month? Yes, you do. Can we now moving from the prepaid expenses into the expenses certain amount? Now, yes, we can. Make sense? Are you guys with me?
Yep.
How about Douglas College? They receive your cash at the end of April. Is that revenue for them?
Not yet.
Not yet. What is it? On the same structure, asset equal to liability and equity. What's that for them?
It's a liability.
Liability. How are we gonna call it? Unearned revenue, remember? When we're going over the different kind of accounts, there was account which called unearned revenue. What's gonna happen on the end of May? They're gonna earn some of that revenue, correct? So what they're gonna do, they're gonna move it from the liability into the
Revenue.
revenue. Make sense?
Yep.
All right. Why is called deferral? Because on the time when you receive the cash, they don't recognize in the revenue. What they're doing with the revenue, they push it in the future. Why? Because they haven't provided the service. For you, when you pay the cash, you're deferring the what you're deferring. You're deferring the expense. Why? Because you haven't received the service. So where is the receive? You're pushing the expense somewhere in the future. You understand the word deferral? Have you done ever deferral? CPA students like deferrals. Do you know what deferral is? How when they're doing the deferral? Deferral is any time before the 8 o'clock on the day of the exam, you can defer the exam. It's very common for the CPA student to pass the assignments to go for the exam, to be qualified for the exam, to register for the exam. And the day before the exam, he call and say, I want to defer my exam. Like postponing, exactly. And the CPA gonna tell you, oh, yeah, no problem at all. Pay. There's some fee. Pay the fee, and you can defer it. But next exam session, you have to take it. Yes, postponing is the right thing. So what we're gonna postpone? When we receive the cash, I'm gonna postpone the revenue, and when they pay the cash, I'm gonna postpone the expense. The revenue, in the meantime, I'm gonna keep it as a liability. Expenses, in the meantime, I'm gonna keep it as an asset. Once I receive some of the services, I'm gonna move asset into the expenses. And once I deliver some of the services, I'm gonna move the liability into the revenue. That's the deferrals. Now let's see the accruals. Accruals is the opposite. We're gonna recognize the expense before we pay the cash, and gonna recognize the revenue before we receive the cash. For example, do you remember the example with the electricity? We work from home, we're using the electricity. Uh, that's our expense for the revenue that we're receiving, but we don't have the invoice. But do I know the invoice gonna come? Yes, I know. Do I know that I have to pay for that invoice? Yes, I know. So what I'm gonna do? I'm gonna record the expense and I'm gonna show it as a liability. When the invoice comes, I'm gonna close that liability by paying cash. On the revenue is the opposite. I provide the service to the client, but the client says, I'm gonna pay you next month. I'm short on cash. We want to keep the client because on the long run, he's a good client. So we're gonna recognize the revenue. We're gonna show the accounts receivables. When he pay, we're gonna close that accounts receivables. That's our accrual. So accrual is when the expense and revenue happen, but cash will happen in the future. Deferral is when the cash is already happened, but revenue and expenses are pushed in the future. Make sense? So for that reason, we have prepaids and accruals on the timeline. Prepaids, we receive the cash, we push the revenue expenses in the future. On accruals, we recognize the revenue expenses, but the cash is going to happen in the future. What type of accounts, what type of adjustments we have? We have again 5 type of adjustments. In the big picture, there are 2 categories: deferrals and accruals. On the deferrals, we have prepaid expense, unearned revenue. On accruals, we have accrued expense and accrued revenue. That's 4. The 5th one is amortization. Now we're gonna talk about first about the prepaid expenses and unearned revenue. Then we're gonna talk about accruals, accrued expenses and accrued revenue. And we're gonna leave this amortization for the very end. So let's go now. Before we start, there's some rules. First rule number 1. Accruals, or those adjusting entries, accrual deferrals, cash is never, ever, ever, ever involved. Debit or credit cash is not an option. Again, when you're doing adjusting entries, either prepaid and deferring the expenses and revenue. Either accruals, expense and revenue. Cash is never ever involved. Use any other accounts, no cash. Adjusting entry, we're gonna either increase the revenue or we're gonna increase the expenses. So now, having this in mind, let me copy this. And let's do some thinking here. I'm gonna open one Excel spreadsheet. I want you to understand the thing, just to picture it. But I believe you have to make it visual for you so you can actually feel it. Otherwise, we can talk all day here without the blackboard. It's very difficult for me to make you realize what's actually happened. So let's go to this Excel spreadsheet, use the Excel spreadsheet as a whiteboard. So on the big picture, I have this accounting equation. Let's make it bigger. I have this accounting equation, which is asset is equal to liability plus equity. What do I know? I know in the big picture, if I draw the T accounts, if I prepare this as a T account, if I draw the line right here, I know that my left side is debit, right side is credit. That's my debit here, that's my credit here. I already know that. I know that these accounts, asset account, always have debit balance. I know these accounts always have credit balance. But I also have a net income, right? Net income comes from the revenue minus expenses. And in the big picture, if I put revenue expenses on one line, let's see, this is the expense and this is the revenue. What do I know? I know that expense always and always and always have on the debit side and revenue is always on the credit side. We already established this. So this is my debit here and this is my credit. So watch this. Let's pretend that we have a transaction and that transaction involves prepayment of cash. Let's say I prepaid for my insurance. If I pay for the insurance, when do I have to pay for the insurance? Before the period start or after the period start?
Before.
Before. So did I receive service?
Not yet.
Not yet. So what is for me then?
Asset.
It's a prepaid expense, correct?
Yes.
In the very beginning, that's a prepaid expense. That's too big now. Let's make it small. Later on, when I start using it, when the period pass, let's say 1 month pass, this prepaid expense has to become expense. Make sense? So what I'm gonna do, from the prepaid expense, I'm gonna move it to the expense. So let's see how this is gonna happen. In the very beginning, I'm gonna have, let me reduce the font here. Let's go with 24. In the very beginning, I'm gonna have debit prepaid expense, credit, I'm gonna pay cash. Correct? So now I have here asset, which is settled with another asset. Later on, I have to move this asset to the expense. So watch this. When it's prepaid expense on the debit side, you can only flip it to another debit side. But the only options that you have is expense. There's nothing else. Now, how can you flip from debit prepaid expense into expense? Well, you're gonna create the prepaid expense and you're gonna debit the expense. So what we're gonna do, debit expense, and credit will be prepaid expense. That will be prepaid expense. And now you make it asset, move it to the expense. Make sense?
Yes.
Now let's see what's going to happen if you're on the other side of the equation. On the other side of the equation, what happened now? I'm receiving the cash. I'm getting the cash, but I'm not providing services. Not yet. What's that for me? I have to credit unearned revenue. But we already established unearned revenue is liability. Make sense? Now this unearned revenue, when we start providing the services, it's going to become, what's going to become? It's going to become revenue. Why? Because that's the only option that we have. I cannot make an unearned revenue to become expense. Why? Because it's already recognized on the credit side. From credit side, it can go to another credit. You cannot go to debit. Debit already gone. Debit is in cash. So from now, I can only move credit to another credit. And what I'm going to do? I'm going to do debit unearned revenue, credit revenue. Do you understand this? Debit, which is asset, the only option you can move it is to another debit, which is expense. And credit, which is liability, you have to move it to another credit, which is the revenue. You cannot move it anywhere else. So that's why in the big picture, when you're paying cash, either you're paying for the asset, either you're paying for the expense. Once you receive the service, that's going to be expense. But once you haven't received the service yet, it's going to be prepaid expense or asset. And you're going to stay asset until you receive the service. On the opposite side, so when you receive the cash and don't provide the service, it's a liability for you. Why? Because either you have to pay the cash back, either you have to provide the service or deliver the goods. Once you deliver the goods, then you can recognize the revenue. Now let's go to the slides and having this in mind, let's start working with the questions there. Again, as you can see, cash on the adjusting entry. So of those adjusting entry, of those entries that I show you here, which one are the adjusting entries? Let me show you which are exactly the adjusting entries. This one is the adjusting entry, and this one is the adjusting entries. In the first one, we're moving asset into the expense. In the second one, we're moving liability into revenue. Why? Because the cash already happened. In this case, we're dealing with the deferral. We deferred instead of going with the expense. In the meantime, I put it as an asset, deferred that expense in the future, Once we start receiving the service, I'm recognizing the expense. In this case, I received the cash, I deferred the revenue in the future. Until when? Until start providing the revenue. Once it's providing the revenue, now I can moving the liability into the revenue. Prepaid expense. Again, prepaid expense, we pay in advance for the expense, which we haven't received yet. That represents the asset. Why? Because we're waiting for the future economic benefits or something to be delivered to us in the future. What's the interesting part is the cash is already happened. What's the example here? The example can be exactly the tuition fee here for the Douglas College. The other example would be prepaid rent. Question for you: when you paying the rent at the beginning of the month or at the end of the month? Uh, any of you who paying rent in the beginning of the month? In the beginning of the month, have you received the service yet?
Not yet.
Not yet. What has to happen? The month has to expire or the month has to pass. When the month pass, then yes, become expense for you. Until the month is passed, that's not expense. That's a prepaid expense. Same thing for the person who received the cash. It's not revenue until the month expires, and then become a revenue. Same thing with the prepaid insurance. Supplies also fall in this category. We want to see why. Now let's go with this example here. Let's pretend that we have this insurance policy, which we purchase annual insurance for $3,600. I'm going to copy this. I already copied it, and I'm going to move to the Excel spreadsheet. And let's work on the Excel spreadsheet. May format it a little bit so we can do the debit and credit here, and we're good. So we purchase the insurance policy. As you know, the insurance policy first you have to pay, and then you can enjoy the insurance. If you don't pay, there's no insurance. So what we did on May 1st, we purchase insurance. What do we get? Debit. What will be this for us? Is it going to be expense or is it going to be asset? What do you think? Let me turn on the chat so I can see what you say. We purchase insurance, which is for 1 year from now. Today we purchase the
Or
insurance. Today,
asset, it's prepaid expense.
what asset is going to be? Prepaid insurance, right?
Yes.
Did we receive the insurance? No,
Not yet.
but we pay cash. So credit will be
Credit cash.
cash. And how much cash we're going to pay?
3,600.
So 3,600 is going to be our prepaid insurance, and we're going to pay for that exactly the same amount cash. So debit equal to credit, we are perfect. For how long is this insurance?
1 year.
1 year. It's for 1 year, right?
It's an annual insurance policy, so yes.
Annual, yes. So for the year, 3,600. How about per month? How much is per month?
300.
Why is 300? How many months the month has?
12.
months per year, sorry, months per month. Months per year. We have 12 months per year. So how much will be per month? 300. So what that means? Every time on 1 month pass, I can recognize $300 expense and move from the prepaid insurance $300 into insurance expense. Make sense?
Yes.
Let's start doing it. May 31st. What do you have to do? Now we have to do the adjustment entry.
Debit
And
insurance expense and credit prepaid insurance.
insurance, thank you. Expense and credit prepaid insurance. Why? Because 1 month expire. And now I start moving that prepaid insurance. Let's pretend for a second we're doing the same thing in June, right? June 30th, exactly the same thing. July 31st, exactly the same thing. How this entry is gonna change? Month to month. It's not gonna change. How the amount's gonna change? Never gonna change. Let's pretend now we are August 31st. And we did this entry. Now the question is, if I have to open the T accounts, I'm gonna have here T accounts for the prepaid insurance. What kind of account is that? That's an asset account, correct? What's interesting with asset account? The asset account has a debit balance. So my insurance expense, prepaid insurance, if this is a debit and this is a credit, my prepaid insurance is gonna have debit balance. So beginning balance gonna be here, ending balance gonna be on this side. Correct? My beginning balance at the before the May 1st was zero, correct? Then I purchased insurance for $3,600. Are you guys with me?
Yep.
Then what's happened? I have one, two, three, four deductions for $300. What's my ending balance at the end of August?
2,400.
2,400. It should be my balance. Why? Because I have 300 for May, 300 for June, then I have 300 for July, and I have 300 for August. That's in total $1,200. Now, how many months pass? Can you see? At the end of the
4,
August, 4 months. How many months left?
8,
So months left will be 8 months, correct? How much is per month?
300.
300. Do I have 2,400 sitting for me?
Yep.
Yep. So that means I'm correct. If the year end, watch this. If the year end of this company is December 31st, how much will be the balance of the prepaid insurance account? in December 31st. December 31st. When the insurance gonna expire? I purchased the insurance on May 1st. On which day the insurance gonna expire? Are you guys with me? If I purchase annual insurance, which start on May 1st, on which day that insurance gonna expire? Think again.
April 30th.
April 30th. That's where 1 year expires. Okay. So on December 31st, did 1 year expire?
No,
No. How many months left?
4.
4. How much is per month?
300. So you should
300.
have 1,200 left.
So I have to have here 1,200 left. If I don't have 1,200 left, what that means? I
You
make
made a
mistake.
mistake.
Thank you. That makes sense?
Yes.
Awesome. Do you understand this example?
Yep.
How about the rest? Okay. Lena, I'm not hearing anything from you. Are you okay with this? Lena, are you okay with this? Do you understand this logic? Okay, great. Let's move on for next one. I kind of, when we're going over the lectures every week after week, I kind of developed the sense that there are few key people here, which once I'm waiting for those key people to tell me yes, 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 and once I receive those confirmation from those key people, then I kind of moving forward. I don't know if that makes sense to you, but at least I'm trying to, communicate with you any possible way. And once I hear the feedback from the people that usually give me the feedback, then I can move to the next topic. And if it's one of those people who usually give me the feedback and saying, yes, I understand, they delaying that responses, that means I have to repeat again. So let's go with this one. What happened now? Insurance policy, again, 3,600 for 1 year. What that means, we're gonna have the asset, prepaid insurance, which is settled with another asset, cash. Why do we need this prepaid insurance? Because we want to protect ourselves in the future. So in reality, that's expense. But since the time hasn't passed yet, it's not expense yet. When is gonna become expense? When the period start passing. What's the shortest reporting period? A month. So when the first month expires, can I recognize some of from the expenses, insurance expenses? Yes, I can. How much I can recognize? Only 1/12 of $3,600. Why? Because the $3,600 is for 1 year, which 1 year has 12 months. Why 1 year has 12 months? Because we're on planet Earth. If we change the planet, that's not going to be accurate calculation. Then we have to come up with different calculation. But since we're on the planet Earth and we're teaching Earth accounting, that's how it's gonna be. You're laughing, but one day when your kids move to Mars, who do you think is gonna do the accounting in Mars? I'm not gonna be around to do accounting, but at least now I'm planting the seed so you can be prepared that one day when you have to teach your kids to do accounting on Mars, they have to adjust. Instead of 12 months for the year, they can add like a more months for the year. So that calculation is going to be different. Obviously, the age on Mars will be different as well. So imagine two people, one from Earth and one from Mars, going on the date, and the the Earth person is asking, "How old are you?" And the other says, "I'm only 14." "Oh, you look like a 20." "Well, that's because I'm living on Mars, right? When you're living on Earth, you're like a 20, 20. But in Mars, you'll be like a 14. So that will be create a lot of confusion. Believe it or not, believe it or not, um, ChatGPT has problem with that. I tested ChatGPT, and when you're moving from the dimension of time, the ChatGPT cannot process it yet. Maybe later it's going to process it, but not now. Uh, if I catch you on the intermanagerial accounting, remind me and I'll show you. It's very interesting finding. I have it recorded. So let's go with this one, with our adventure here, with the prepaid insurance. Okay, the prepaid insurance on May 1st. On May 31st, 1 month already passed. So what's happened now? Our prepaid insurance went down with $300, but our insurance expense increased with $300. Now, in our example here, when we're doing on the Excel spreadsheet, by the end of August, our prepaid insurance is $1,400. How much is our prepaid expense for the period from May to August 31st? Then will be the difference, correct? 3,600 minus 2,400. The difference will be our expense. At the end of the December 31st, our balance, since the how many 4 and 4 8 months pass, we're going to have ending balance of $1,200 waiting for us. What that means? That means that our insurance expense from May 1st to December 31st, the total expense will be $2,400. Now, what will be our insurance expense on April 30th when we're doing the final entry, adjusting entry? What do you think?
300 again.
3,000? So
300
no,
again.
300 again for April, but in cumulative from May 1st to April 30th,
Oh, cumulative, it'll be 3,600.
3,600. How much will be our ending balance on the prepaid insurance account?
0.
Zero. On April, I have to see here zero. Make sense? So now, can we flip this question and let's flip it for the for you paying for the education. So on now let's change the date. On April 30th, let's say on April 30th, you have prepaid education expense, correct? And you pay in cash. Let's say you pay 1,000. Now, but you're paying for semester, right? How many months the semester has? That will be 1,000 months per semester. It's gonna be 4 months, correct? So how much will be the expense amount per month? 250. Make sense now? So May 31st comes. What's the journal entry that you have to do now? Let's clear those one so they not bother you here. May 31st comes. What will be the journal entry? No, let's do first the April 30th. Let's start with April 1st. Let's start logically. On April 30th, you have to pay for that. What's going to happen? Debit. Give me the debit. Which account I should debit? Actually, we did it. I'm sorry. It's already here. April 30th. Debit prepaid education, 1,000, credit cash. Now the first month comes. May 1st comes. What do I have to do? I have to move it from prepaid education into
Education expense.
let's do it. Debit education expense. How much I'm gonna move? 250. And I'm gonna credit prepaid education. What's gonna happen on June? Exactly the same. How about July? Exactly the same. How about in August? Still the same. Now what's gonna happen with our let me clear the sheets here because we don't need obviously those one. So what's happened now with our prepaid education? In April, we started in April, correct? We have here 0. Then uh, we added 1,000. Then in May, we deducted 250. In June, 250. Oh, that's too many. In July, 250. And in August, 250. Now, how much is our ending balance at the end of August? Looks like 0, right? Well, it's not going to be 0. How much going to be? It's going to be 1,000. Why? Because at the end of August, you have to pay for the next semester. I'm sorry. But yes, you're right. The balance for this semester is going to be 0. And then you're going to start the same calculation in the next semester. Make sense? Okay, great. So now, one more thing. One more thing before we continue with this. I want to show you something. I'm going to copy this. I'm going to flip it here. Let's play a little bit with this T account. Now, obviously, once you see the beginning balance and ending balance of the on the debit side, this is asset account. No questions about it. Now, what will be the name of the asset account is irrelevant. Is it going to be prepaid expense? Is it going to be cash? Is it going to be inventory? Is it going to be accounts receivable? It doesn't matter. Make sense? Just remember, this is asset account. Once you see beginning balance, ending balance on the debit side, asset account. No questions about it. Now, what's interesting with the asset account? Beginning balance plus the debit always and always going to be equal to credit plus ending balance. And that's always going to be the same. What that means to you? If you have in your pocket $20 and you want to go for shopping in Metrotown, you swing by to the ITM and you withdraw $150. You went to Metrotown, you spent $130. How many dollars you have in your pocket? Are you sure about it? It's not 20, right? It's 40. Yes, it is 40. So what we did, we solve it for the ending balance. So what we did, the ending balance is going to be equal to beginning balance plus the debit minus the credit, correct? So 20 plus 150, 170 minus 130, 40. That's one option. The other option, let's see another option here. Gonna flip it. No, that should be okay. Let's flip it here. You have in your pocket $10. You went to Metro Town and you spent $250. You went home and you found in your pocket $30. How many dollars you withdraw from your bank account? What we chasing here? We're chasing our debit. Am I sharing my screen with you? I am.
270.
270. So what we have to do, we have to find the debit here. How are we going to find the debit? Credit plus the ending balance minus beginning balance. So 250 plus 30, 280 minus 10, 270 here. Do you want another question? Another riddle like this? Yes or no? Anyone who has kids at home? Is there anyone who have kids?
Yes.
Oh. Okay. Imagine this. You open the fridge. You open the fridge and you saw that you have in the fridge 1 liter milk. You know by experience, but that your kids drink milk every morning. Imagine you have 3 kids and they drink milk every morning. And within the week, they're gonna drink around 6 liters. On Sunday, you know that one of the kids has a birthday, so you have to make a cake, which using the milk for cream, because you have those special cream, which I'm gonna give you the recipe one day. And then you need 2 liters milk. How many liters milk you need to go and buy right now from Costco?
7.
Do you understand the practical application of those calculations? How many of you doing this calculation every day without even realizing it? And we can go over and over and over and over again. So one problem will be how much to buy. The other problem is how much I used. And the third problem is how much I had in the beginning. Those are the questions that we have in accounting. And those are the questions that usually people ask, especially the users of financial statements. They want to know how much are my expenses, from where they came from, how much cash I used, how much left, how much was my accounts payable in the beginning, how much I additional added, how much I paid, how much left. And we're going to repeat this over and over and over again. Now let's move on to our second adjusting entry. We move from the prepaid expenses. Let's go another one. Supplies. Now watch this. I'm gonna copy this, move back to the Excel. Let me move here. Now I have to do some cleaning here. I'm gonna clean all this stuff. I don't need them. I need this account though. And yeah, we can use this one. But I want it a little bit up. Let's put it here. And this part I don't need. Let's eliminate those ones. Okay. Gonna delete this one. I'm gonna copy the scenario from again from the slides and gonna paste it here. So on May 2nd, let's do the journal entry now. May 2nd, we purchase supplies for cash. Debit. Give me the debit. What the company get? Let me see if I'm sharing my screen. I'm not sharing anything. Oh no, I'm sharing it. What the company gets? Supplies. Debit supplies. For how much? For $1,500. What the company give up? Actually, let's move it from here. Let's move it all the way here. What the company give up?
Cash.
Cash. How much cash? The same amount. So credit who's gonna be cash. $1,500. Debit equal to credit. We're perfect. Now the next thing that happened is let me move back to the Excel. Next thing that happened is on May 31st, we made a physical count on our supplies. And we find out that 1,000 left. What shall we do? So what's happened here? Let's go to our account, which is asset account, right? That's why I keep this asset account here. Actually, I can get rid of this one too. And move the asset up. So we have our asset account, which in this case is supplies, correct? Which is still asset account because the beginning balance is debit. Beginning balance on May 1st was zero. Then we purchase $1,500. On the end of the month, we checked the supplies and we found 1,000. How much supplies we have used? 500. Okay. Now we have to adjust this account, correct? So on May 31st, we have to make this adjusting entry. What should I do? Debit. Obviously, supply is going to go down on credit side. So I have to plug here credit 500. Credit supplies 500. But before I do that, I have to debit something. When I
Supplies
use the
expense.
supply expense. And credit is going to be supplies. For how much? $500. $500. Is this ever happened to you? So listen, I'm going to give you one example which happened to me yesterday. And you tell me if this ever happened to you. Now, yesterday, we went to Costco in the morning and we get this cheesecake. right? We have one cheesecake. So now in the fridge, I supposed to have one cheesecake, right? But I have to stay and work. In the evening, I'm going home. And what do you think I found? I know I get the one cheesecake. And guess what I found? There was only half of the cheesecake now. Yes, half of the cheesecake. Now the question is, what's happened with the other half? Or what become? Become expense. Why? Because remember, we have to match the expense with the revenue. And the revenue in this case is the benefit of enjoying the cheesecake. So somebody get the enjoyment for enjoying the cheesecake, and we have to match the enjoyment with the expenses, and half of the cheesecakes went to the expenses. So what we're gonna do? Debit cheesecake expense, credit fridge. Why? Because the cheesecake was in the fridge. Now from the cheesecake become cheesecake expense. Make sense? And you're going to see so many things like this, especially when we're talking about the office supplies in terms of the items that you have in the fridge. Let's see, imagine this. Have you been in the, I was joking this today with the other group in the morning. Have you have this moment? So you're watching, you finish the dinner, everything's fine. Then you start watching this movie, which is kind of suspense movie, and you're having this moment, you cannot stand it. So you're wondering what to do, and you're going to the fridge, open the fridge, and first thing that you're just grabbing and start eating, and going back to the fridge to the movie, and then this happen again, and in the morning you don't even remember, did I eat this? Did I not eat this? So what's happened? You had something in the fridge, right? And in the morning you found something else. So now what you have to do? You have to adjust for whatever went out. How are we going to do that? Debit supply expense, credit supplies. That's what's happened with the supplies. We had it. Now we're checking the ending balance and figure out how much we use. Because sometimes you're just using it. It's a way easy you to check the ending balance and to find out how much you used. So let's go with another one. We covered the prepaid expenses. Now let's go to amortization. I'm going to leave it for the end, not now. Let's go with the unearned revenue now. What's going to happen with this unearned revenue? First, we're going to get the cash and we're going to show it as a liability. And later on, we're going to move the liability into revenue. Let's see how this is going to happen. First, we receive cash. Let's stop sharing this, move to the Excel again. Better start fresh. We receive cash advance for $3,000 on May 20th from a customer for 30-day project. So what's the journal entry? Obviously, we have to get the cash on May 20th. We're gonna have debit cash now for $3,000. Now the question is, did we provide the service? We get the cash, but did we do anything for this client? Not yet. So what's that for us? Is it revenue now? Not yet. Which account I'm gonna credit now? I cannot create revenue account. Which account I'm gonna create? Still gonna be revenue, but it's gonna be unearned revenue. Make sense? I'm gonna push recognition of the revenue in the future. Yes, $3,000. And we're done. Now, the next thing that the slide's gonna tell us that I'm gonna copy it and then I'm gonna come here. The next thing that slide's gonna tell us is this. Adjusting the unearned revenue is required as the revenue is earned. We already know that. The question is, when we earn it and how much we earn. During the last 11 days, this company will have earned 1/3 of the 3,000 or 1,000. So what's the journal entry? 11 days from May 20th. That makes us May 31st. What's going to happen on May 31st? We have to earn something, right? How much we earn? Can you see? 1,000. No questions about it. What will be our journal entry? Now we have to move it unearned revenue into the revenue. How can I do that? Debit. Which account I have to debit?
Unearned revenue.
Unearned revenue, which is my liability account. So what I'm doing now, I'm reducing my liability. Why? Because I provide the service. For how much? For 1,000. And I'm gonna move it to revenue. So that's how you're moving unearned revenue into the revenue for 1,000. So what's happened with my, if I have to chase now unearned revenue account, let me grab here one of those accounts and flip it here. And let's think about it for this account, what's going to happen now. Now, first of all, this is not asset account, correct? No, we're dealing with a clearly liability account, which is unearned revenue. What's interesting with the liability account? It's pretty much the same like a asset, but everything is the opposite. So beginning balance is on the credit side, ending balance is on the credit side. Now that's going to change the equation too, right? What will be my equation now? My equation will be beginning balance plus the credit now, because the credit is the one that the account increasing, should be equal to debit plus the ending balance. And that's how it works for the liability and equity equally. So what happened with this? In the very beginning of May, we have zero balance. Later on, we receive cash for 3,000, which triggers this credit unearned revenue of $3,000. At the end of the month, on the 11th date, we moved out from this account $1,000 because we debit unearned revenue for $1,000 and we move it to the revenue. And what will be our ending balance in this case? It's going to be beginning balance plus the credit minus the debit is going to be $2,000. When we're going to close this $2,000, when we provide the other 2/3 of the services. Until then, you're just sitting and wait. Make sense? Let's go back to slides now. So once we have the revenue, we recorded the revenue, cash and unearned revenue services, and once we receive it, once we recognize it, 1,000 moving from the unearned revenue into the service revenue. And what's going to happen? Liability is going to go down with 1,000 and the revenue is going to increase with 1,000. How much will be our liability? $2,000. Now let's do the accruals. Let's finish the accruals and I'm going to let you for break. What is accrual? Accrual is something, either expense, either revenue, no other options, which we're going to record before the cash is exchanged. So again, in this case, the accrued expenses will be expense which happen, but we haven't paid yet. Let's see the example here. This company, they have employees, they're working. They paying the employees bi-weekly, bi-monthly salary of $4,000 in total. Every month, 15th, 4,000, 31st, 4,000. The problem was that May 31st, it was on Saturday. And because it's the weekend, we decide to pay them on Monday. In reality, that's never going to happen. You're going to get your payment on Friday 30th, but let's pretend that that's what's happened in reality. So the question is, we're sitting on May 31st, which is our month end, and we're asking ourselves, is these people actually work for us? What we're going to say, yes or no? Did the employee actually work for us? Yes, they did. Did they provide the services? Yes, they provide the services. Do I owe them money? Do I owe those poor people money since they work for me? Yes, we owe them money. How much we owe them? 4,000. Do I have to show my expense for May in May? Yes, I do. Do I have to record my liability that I owe my employees for the something that I receive, the service they receive for May? Yes, I do. So what's going to be my entry on May 31st? What do I have to do? I have to show my expense, debit. What kind of expense will be that? It already says, right? Salary is expense. Am I going to pay for that expense? No. Now I have the expense, right? It's not like before, I don't have the expense. I have the expense, but am I paying it? No, I don't. So what will be that now for me? Credit is going to be liability, right? What kind of liability? How are we going to call this liability? In this case, we're going to call it salary payable. And what will be the amount of that salary payable? That salary payable will be for the amount of $4,000. Now, on June 2nd, which is Monday, we transfer the money to the people. Let's do the payment on June 2nd. What's going to happen on June 2nd? Debit. I'm going to pay them salary payable by closing the payable and give them cash. For how much? For $4,000. Now, do you see something interesting? If there was no month end, which is right here, this is the splitting point. If there was no month end, I don't have to do this. But since there's a month end, I have to do it. Let's pretend that we are on May 15th. Oops, not this one. Let's insert. Let's pretend we are on May 15th. What was our journal entry on May 15th then? We did debit salaries, expense, $4,000, and then we credit cash, $4,000. Why? Because I'm paying them right away. There's in the middle of the month, the transaction happened. So what's happened then? On 31st, I created this account, which I bring the balance credit. Let's grab this account, liability account. I created this account, which is payable. What I did in this account? I bring the balance 4,000 and then I close it 4,000. How much is now the balance of this account? 80. Temporarily, I have the balance. So if you look closely, if I eliminate this and I eliminate this, then what's left? Salary expenses and cash, which is exactly the same entry which I have on the 15th. So what I did, for the time being, I show my expense, creating liability, recording the liability. Later on, I'm closing the liability with the cash. Why? Because I have a period end. Now let's do and see what's going to happen with the accrue or revenue. Again, with our example here, first we're going to show the salary expense, show it as a liability, and later on June 2nd, we're going to close that liability with paying cash. And that liability will disappear. Now let's see what's going to happen with the accrue revenue. Accrue revenue will be when we provide the service or deliver the goods, but we haven't been paid yet. Let's see this company. Move back to Excel. And this company is hired on May 15 to provide the monthly service for $3,000 per month. With the first payment to be received on June 15th. Service is provided from May 15 to May 30th. Now, the adjusting entry for May 30 to record the 2 weeks of the revenue is, what will be that? So again, we have to provide on May 15 to provide monthly service for $3,000 per month, with the first payment to be received on June 15. Service is provided from May 15 to May 30th. What we have to do? We have to show the revenue for the period. For the month, how much is the revenue for a month? For 1 month,
3,000.
$3,000. Do we have from May 15 to May 30? Do we have a month? Full month?
No.
No. How much we have? Half month. How much is for half month? Half of 3,000, right?
15.
1,500, right? So on May 30th, what do we have to do? We have to record something. Month end comes. Debit. Did we provide the service? Yes, we provide the service. Did we earn the revenue? Well, since we provide the service, we earn the revenue. Are we going to get paid? Yes, on June 15th. How about on May 30th? Are we due to receive money? Yes, we are. So what will be that for us? Accounts receivable. Make sense?
Yes.
And which account I'm going to credit now? The account that shows that we provide the services. Credit revenue. How much? Same amount. So how much will be our amount in this case? That should be $1,500. So $1,500 here and $1,500 here. And we're done with this. Make sense? What's going to happen when the revenue is when it will come for the June 15th? What's going to happen on June 15th? We're going to collect the cash, correct? Debit, cash, and we're going to get now 1,500. We're collecting only these accounts receivables, nothing more. And we're going to collect credit accounts receivable. Make sense? 1,500 here, 1,500. Now, also what's happened on June 15th, we provided the second part of the month revenue, so we can collect that cash too. On June 15th, we can also collect the other part of the cash, which is for the full contract, 1,500. But now we're not going to credit accounts receivables, but I'm going to go directly to credit revenue now. Because that will be for the period for June 01st to June 15th. This first one was from May 15th to May 30th. Make sense? So what's happened on June 15 when there's no accounts receivable? Debit cash, credit revenue. In this case, still have cash or revenue, but in the meantime, I'm working with the receivables. I'm creating receivables, which receivables later are closed. Let's go back to slides. And with this revenue, what's happened now? We are going to recognize the revenue of $1,500 at the end of May, which is going to stay as a accounts receivable asset at the end of May. So for the summary, we have prepaid expense and we have unearned revenue. Those are deferrals. And then we have accrue expense, accrue revenue. Deferral means we receive the cash, we push the expenses in the future. Actually, we pay the cash, we push the expenses in the future. Unearned revenue, we receive the cash, we push the revenue in the future. In the meantime, we record it as a liability, but later we're gonna flip it to the revenue. In the prepaid expenses, in the meantime, we show it as an asset, but later when the adjustment comes, we move it where it belongs to the expenses. For the accrual, opposite. We receive the expenses, but we haven't paid yet. So we're gonna debit the expense, we created the liability, which liability later we're gonna close it. For the accrual revenue, we provide the revenue, we didn't get the cash payment. So we're gonna create this asset, which is accounts receivables, and we're gonna show the revenue. And later on, we're gonna close the accounts receivables when we receive the cash. The last one that left is amortization, but let's do the amortization after a break. Amortization. What do you know about amortization? Is there anyone? Do you know anything first? Do you know anything about amortization? Have you heard anything? Yes or no? No. So, amortization in the big picture is, again, don't forget, in order to generate revenue, we need to use assets. Some of the assets are inventory, or some of the assets are cash, but some of the assets are something bigger, like a machinery, like a vehicle, like a computer, like equipment. We're not going to use it only for 1 month. We're not going to use it for 6 months. Not going to use it for 1 year. We're going to use it for a long period of time. Since we use it for the long period of time and we're using it to generate revenue, we have to transfer some of that cost for those assets into the expenses. And since we're using them, those assets are going to start depreciate. And that's what we're going to do. We're going to transfer some of the cost of the assets into the expenses during the useful life of the assets because they help us to generate revenue. We're going to have two main categories: property, plant, and equipment, and intangible assets. Property, plant, and equipment, those are tangible assets. So that means we can see it, we can feel it, we can smell it. With the intangible assets, they don't have physical form. More about the assets, we have chapter 10 in 1210, which is the second accounting. So here we're just going to get very, very basic, brief introduction of the assets. More time you're going to spend with the teacher in 1210, in chapter 10. Now the amortization or depreciation, again, will be allocation of the cost of the asset over the useful life of the asset to match the benefits that we're getting from that asset with the expenses that asset generates to provide those revenue. So let's see how it's going to work. Imagine we purchase this furniture. Let's copy it. Let's copy this and let's move it to the Excel spreadsheet. We purchased these furnitures. Let's quickly adjust it to 22 for $45,000 with expected useful life 5 years. Let's do first the journal entry to record those furnitures. May 3rd. What the business get? The business get furnitures. I'm missing one there. Here, furnitures. For how long? What's the value of those furnitures that we get? The $45,000. Let's put recorded 45,000. And how we pay? We pay cash. Credit, cash. 45,000 gone. But we have now furnitures. We can sit somewhere in our office since we purchased the opened the office. That's great. Now, cost of our asset is 45,000. No questions about it. How many years we gonna use it? Our intent is to use it for 5 years. So how much I have to transfer from the cost of each of this asset every year to the expenses? So per year, I have to transfer 45,000 divided by 5, $9,000. How many months I have per year? We have 12 months. So if I have to go with the months, per month will be 9,000 divided by 12, 750. So every year, every month when I use the asset, I have to transfer and show amortization expense for $750. Now, May 31st comes. That's our first month. What do I have to do? I have to show the amortization expense, debit. Amortization expense for $750 and credit. Now for the credit, what I want now to keep track of this amortization. I want to keep track of the amortization because later on I'm going to do some tricks I'm going to show you in a second. So for that reason, all the amortization that I'm taking in recording for this furnitures, I'm going to keep it in the separate account, special account, which is called accumulated amortization furnitures. And I'm going to keep there the same amount, $750. Every time when I show amortization expense, I'm keep adding this accumulated amortization. So what's going to happen when June 30th comes? Exactly the same thing. On June 30th, I'm going to do exactly the same thing. How about July 31st? Exactly the same thing. August 31st, exactly the same thing. And I keep going to do this until the year 5, when this asset is completely amortized. Now, in the meantime, what I'm going to do is I'm going to keep track of the two accounts. First account will be related to the asset, and it's going to be furnitures. And in that furnitures, my beginning balance was 0. Then I purchase furnitures for 45,000, and that's all. I'm going to keep track of this account. My ending balance will be 45,000. And then I'm going to keep track of the separate account, which separate account looks like a liability account, but it's totally not. It's a companion account to the asset account, and it's going to be called accumulated amortization. In this case, that will be furnitures. Those accounts always gonna go side by side together until the furnitures exist in our office, in our business. Once the furnitures, we amortize the furnitures, this account and the furnitures will disappear together, but you're gonna see this in 1210. So in the meantime, what we're gonna do, we're gonna keep track of all the accumulated amortization that we create. So we have 750 for May and 750 for June. So in total, we're gonna have here ending balance equal to this one plus that one, 1,500. Now, if I have to prepare financial statement or balance sheet for the end of June, on June 30th, when I'm preparing my financial, I'm gonna have account furnitures, and that account's gonna show 45,000. Then I'm gonna have new account, which is less, new calculation, accumulated amortization furnitures with, let's move this one, I'm gonna move it 45, 1, 2, 3. Less accumulated amortization, actually gonna 45, 1, 2, 3. Accumulated amortization 1,500, and I'm gonna have net of furnitures, and that's gonna be the difference between those two. Or it's gonna be 43,500. And I keep going and keep going and keep going until I fully amortize these furnitures. And eventually, my objective is the balance in accumulated amortization furnitures to become 45,000. Now let's see something else. We already know that every month, sorry, not every month, every year has 12 months, correct? We already established. We even established why that happened. So let me go back to this. I'm just gonna post this. This is our requirement. So it says 5 years, correct? So I have to amortize the cost of 45,000. Of 45,000, I have to amortize it over 5 years. I already know that. And we already know all this information. Now, what we have to do is think a little bit. So we're gonna have year one, we're gonna have year two, and we're gonna have all the way to year 5. And then we're gonna have January, then we're gonna have February, and then we're gonna have all the way to December. That's our 12 months. So now the question is, when did we purchase this asset? On which month? In May, correct? So if I have to take amortization for the first year, and I have to show the amortization of the first year, for how many months I'm gonna have in the first year? Let's see, 1, 2, that's 8 months. So how much will be my total amortization at the end of the first year? Are you guys with me? What do you think? How much is going to be my amortization for the first year? $6,000. That's correct. Why? Because I have 8 months, 750 per month, $6,000. No questions about it. Now, second year, how much will be my amortization for the second year? Do I have the entire 12 months? For the entire second year, how much will be my amortization? 9,000. Why? Because I have 12 months. 1 and 2, I have the entire 12 months. 9,000. Year 3, how much will be? Same. Year 4, same. Year 5, same. Now, at the end of the year 5, do I have 5 years? Did I use the machine for 5 years? No. So what do I have to do? I have to add year 6. How many months I need from year 6?
4
Four.
months.
4. 1 and 2 and 3 and 4. And once I add those 4, I'm going to have, how much will be the amortization for 4? 3,000. Now with the first year 6 and the second last year 3, I have 9. So I have 5 years with 9,000 and I'm done. Make sense? So as you can see, every year here, second, third, fourth, fifth, we're going to have a full amortization, 9,000. Only the first year we're going to have a partial amortization. And the last year we're going to have the partial year, which will be equivalent for the months that we miss in the first year. And that's how we're done with these assets. And that's your amortization. So now let's go back to the slides. So for this amortization, again, we purchase the asset. Then we're going to start calculating 45,000 divided by 5 years, going to give us 9,000 per year. But since the year has 12 months, that's going to give us 750. Since the shortest reporting period is a month, every month we have to transfer $750 by making this journal entry amortization expense, debit, create accumulated amortization. Now, accumulated amortization again will be companion account or contra account to the furniture account. And they're always going to go together. Contra account means they're always going to appear together. They're never going to be separated. Normal balance will be credit, but it's going to be acting like on the asset side and they're going to go only side by side. So if you have a building, that building companion account, contra account will be accumulated amortization building. If you have machinery, the companion account, contra account will be accumulated amortization machinery. And they're always going to together as a pair of accounts. And one is going to start with the asset account always going to have the original cost, and the contra account is going to start accumulating the amortization, which are shown as a amortization expense every period. The objective is the accumulated amortization to reach the same amount of the furniture. And if you have to present this on the balance sheet, always going to be furniture, less accumulated amortization, showing, or directly net of furnitures. And there will be here note 1, and once you check a look note 1, you're gonna see what's on note now. And that was for the amortization. And now we have the 5 adjusting entry that we have to do at the end of every reporting period, month or quarter or half year or year. First one is to transfer the prepaid expense into the actual expense or unearned revenue into the revenue by recognizing the revenue. For the accruals, showing the expense and payable, which later will be paid, or recognizing the revenue and showing a receivables, which later will be received. And the last one is amortization. Transferring the cost of the asset as an amortization expense and creating this account, which is accumulated amortization. We're going to start accumulating all the expenses that we transfer to amortization over the life of the asset. And that will be our objective. Let's see what else we have in this chapter left. In this chapter, we're going to have to do adjusted trial balance. We already did a trial balance last time, if you remember. And from the trial balance, we get the balances. The only thing that we have to do, make adjustments and then prepare this trial balance again. And from the trial balance, we have to prepare the financial statements the way we did it last time, by starting first with the income statement, then showing statement of the owner's equity, and finish with the balance sheet. Now, which is the essential feature of the financial statements? Obviously, the heading, which heading always going to be the name of the company, name of the statement, and the date or the period which the statement covers. So which brings us to the point that we have statements which are made for the period of time and statement which is made for the point of time. Income, obviously, net income statement always going to be revenue minus expenses. But in order we to generate the revenue expenses, we need time. So that's why income statement always going to be for the period of time. Statements of owner's equity also is going to be for the period of time. That usually from the start of the year, then what's happened during the year, and what's the ending balance. Balance sheet, it's going to be only and only at a point of time, today, and only today you have those assets, this liability, and this equity. Is this going to happen? It's going to be tomorrow. We have to wait for tomorrow, and then we're going to see. So for that reason, remember it. Net income, income statement, statement of owner's equity, those are prepared for the period of time. Balance sheet is prepared at this point of time. You have this. What you're going to have tomorrow? Well, we have to wait tomorrow and going to see. Statements, we already saw the link between the statements. Net income for the period of time, for the month. Moving to the statement of owner's equity for the same period of time, which then is shown on the balance sheet. At this point of time, you have this assets, this liability, and this equity. Is this going to be tomorrow? Well, we have to wait for tomorrow, and then we're going to see. There are always ethical side with these accruals and deferrals. Why? Because they create a lot of opportunity for manipulation. You can overstate the revenue or understate the expenses, or overstate the expenses, understate the revenue, depends of what you want to achieve. That's why you always have to be diligent, and the person who's doing those accruals and deferrals, it has to be professional, obviously, and trusted person. And that's today's chapter. There's some, 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 there's There's some exhibit here for the prepaid expenses, but I'll check those appendixes if there's anything interesting here that we have to discuss. At this point, we're not going to discuss those appendixes, but if I find something interesting, we're going to discuss it. I wanted we to go over one case and one example today, but we pushed a little bit further with time. So I'm going to leave those examples for the next time. So next time, next week, we're only going to practice questions. And I'm going to go quickly again, remind you about the adjusting entries, deferrals, accruals, amortization, and then we're going to start practice questions. And I hope with the questions, you're going to get a good sense of what we need to do. It's an interesting chapter. Pretty much this is the high-level accounting. I have to warn you about this. High-level accounting. So how you can see it? Accounting, technically, we're seeing the events that happen in the company. At this point, we identifying the event. At this point, we recognizing the event and recording as a transaction. Then we putting the transaction in the ledger, then preparing and adjusting trial balance. Then we're making adjusting entries. There's no transactions here. There's no events here. The only event that happened is we to identify, is the revenue revenue? Is the expense expense? If the revenue is not revenue, that means it's a liability. If expense is not expense, that means it's an asset. Now, if it's an asset, how much of this asset is still asset and how much we have to transfer to expense? If it's a liability, how much of this liability is a liability and how much has to be transferred to the revenue? Or the other way is there any revenue that I can recognize by increasing my assets? Or is there another expense that I can recognize by increasing my liability? So as you can see, there's no actual transactions that happen here. It's mostly a judgment, your professional judgment. So that's why this one creates a lot of opportunity for manipulations. That's why it's a high level account. So sometimes whatever you see is not what it is. Why? Because we have those adjusting entries. We can push the revenue in the future or push the expenses in the future, or we can recognize the revenue earlier before it happened, before the cash happened, or recognize the expenses earlier before we have to pay for the expenses. Preparation of trial balance after adjusting entry is not different than the unadjusted trial balance. And once we have those adjustments, now we can prepare the final financial statements, which are going to include all the transfer from the prepaid expenses into the expenses, unearned revenue into revenue, plus we're going to catch the revenue which we haven't paid yet, plus we're going to catch the expenses that which we for the revenue which haven't received yet and the expenses that we haven't paid yet. And the last thing left for chapter 4 is to prepare the closing entry. The way we're going, I like the pace we're going. I know we're going a little bit slower than the pace, but I feel that you understand better accounting now. Correct me if I'm wrong. I have this feeling that going a little bit slow in the beginning, it's going to pay benefits later. Yes, that's the whole thing. Everything comes to the practice. If you practice, everything will be fine.